What is going on, guys? Good morning. Good morning. 9:30 markets are about to open, and we're going to take a look around the scene at all macro stuff that I watch. This is Rogue Macro, and here we have a theory-driven exploration of global systems, as you can see here, right here in this description. So we go back and we look at macro from a new lens. I have a complete macro theory. I have not published it yet, but I am in the process. This is a multi-year process of getting my thoughts down on this, and it is very contrarian. It fits in a lot with Jeff Schneider's Eurodollar system, but also brings in monetary evolution in a different way. So we will touch on that a little bit later, but right here is the Substack, roguemacro.substack.com. Go there and subscribe. You can just subscribe to the free tier. I put out some blog posts, some videos, some podcast episodes, or you can support me there and support independent macro content. All right, let's get into the charts. So this is the DXY, the dollar index, the major dollar index. And as you can see here, this horizontal line, what I did was I went back and all monthly candles, the average strength of the DXY from the inception of this index has been 99.01. So the dollar is not weak right now. The dollar is actually strong. And if you zoom out and you look at it, say, going back to the Great Financial Crisis. So I got to clean up this chart here a little bit. Hold on. Let's clean this up. So if you go back to the Great Financial Crisis in 2008, 2009, that was the low. And the dollar has been up ever since. And this usually confuses people because there's been a ton of QE. There's been a ton of stimulus, government spending, yet the DXY is going higher. Of course, this is against other major currencies. We can go and take a look at other dollar indices here in a second, but I wanted to point this out. So if we go back to the daily, and I want to hide this line now, we are breaking above 100, and I think that's an important level. If we go back here and measure from this high that we got to back on July 31st, we are breaking above that right now, as you can see. So that's a very important level. Where are we going next? Most likely we're going a lot higher, a lot to the upper part of the range. So if we zoom out here again, let's go to the weekly so we can make some sense of this. You can see that it's going back higher. And this range that I'm talking about, one thing I have for this entire cycle, I've been saying that we were going to enter a new higher range. Of course, I thought the range was going to be up here, somewhere like this. Okay, but we did break down below that. So that was not entirely correct, but I think it's going to be correct conceptually, right? That we are entering a higher range. One thing I also did call this top pretty close, because what I did was I just ran an extension down like this, a Fibonacci. And if we open it up to the 1618, I called the top right there. And yes, it did go a little bit higher, but that would have been a very good buy and sell up there. So that was a pretty good call as well on the dollar for the top. But if you scroll back here, and let's do this again, we've had a series of ranges, right? So that was a range. Then this was a range. And so I concluded that we were going to enter a higher range up here. Again, that has not happened, but the concept is sound. We have not returned to these lows that we saw post-COVID of 89 or so. We've stopped right around 99, right around that long-term average for the DXY. But what's going to happen when this gets stronger is it's going to squeeze a lot of those foreign countries that load up on dollar-denominated debt when the dollar is weak. So there's trillions and trillions of dollars from foreign governments that they load up on. They issue the debt in dollars. Even foreign governments will issue debt in dollars. They need dollars to repay that dollar-denominated debt. And so there is this built-in demand for dollars. A lot of people say that the U.S. military backs dollars, but that's not the case. Actually, dollars back themselves, because every dollar of debt, which is how you print money, that's how you print dollars, is banks make loans. So every new dollar must be repaid. It must pay back itself. And so there is a built-in unit of demand, $1 unit of demand for each new dollar that is created through a loan. So it backs itself in that way. It's financial engineering at its finest. But I just noticed this one. We are at this long-term support turned resistance as well. We'll see if we can break up above that. Very interesting that that is also right around the $100 mark, or 100 mark on the DXY. But I do expect this to get stronger and to squeeze the foreign markets. Now, I've recently published a few things to the paid tier, and I've been talking about how this is the great divergence. It feels like a great divergence. So the US GDP estimates are 4% annualized for Q3. That's very hot. 4% annualized. Stock market's all-time high. There's a bunch of other signals out there that are showing that the US economy is getting heated up. But at the same time, we see things like gold skyrocketing, gold to copper ratio, signaling recession. We see unemployment start to tick up. So we have some recessionary signs. But it's very weird, the situation that we're in right now. Bullish on one side of the market, bearish on the other side. And the conclusion I've drawn is that it is this decoupling. It is deglobalization. It is the tariffs, the trade war, that is causing pain abroad and somewhat of more growth domestically here in the United States. Now, will that last? We will see. If this were the old days, if we were going back to the great financial crisis, everything was globally synchronized. Everything, there was this web of credit default swaps. All the banks were connected. And if one bank had trouble in China or Germany, that would spread contagion to the rest of the world. We're seeing much less of that now. And I think that contagion is going to be much more localized. The dollar is still kind of tying everybody together here. And as we see a strong dollar continue higher, that's going to squeeze the world. But it's going to be minimal in the United States versus the rest of the world. Let's take a look at some other dollar measurements here. Have these pulled up. So this is the trade weighted dollar. This is weighted for, who the U.S. trades with, not necessarily those big currencies. So DXY was a big dollar index that tracked with the Deutschmark, the French franc, the lira, the pound, the yen, all these things. But when the euro consolidated, a lot of those got consolidated into one. So DXY is a majority. It's like 2/3, 66% euro. And then you have the yen and the pound and the Canadian dollar and some other majors, but they're small fractions. Okay, so the trade weighted dollar, though, it has like 100 different currencies, all weighted according to how much we trade with them. So this includes the Chinese yuan. It includes the Mexican peso. Those are two very important currencies that are included here in the trade weighted dollar that are not included in the DXY. And as you can see, we are rounding this bottom, breaking up from this level. Importantly, right here, breaking up above that. And there's not really any resistance above that. So it can go right up to the top. in this range, I would say, we're probably, see if we zoom out, there's probably some sort of range like this. What are we on? Let's go to regular. It's not going to be perfect, but something like this. Maybe we can shorten this up and then lengthen this out. Something like that. So it's not going to be like the dollar wrecking ball is going to happen all at once and it's going to be the end of the dollar system or the end of the global economy, whatever. It's going to happen in phases, in stair steps with the business cycle. That's natural what is going to happen. And so we'll see these spikes and we'll see these drawdowns. Okay, we can also, there's another measure of the US dollar, and this is emerging markets. So this is trade weighted, but with emerging markets pretty much only. And you can see it's very strong as well. It has been strengthening. So when people talk about the death of the dollar, they don't know what they're talking about. The dollar is strengthening on all of these measurements. Again, here is the emerging markets. Here is trade weighted. And you can see it's not in any danger of going lower. It's actually breaking back up to the top of the range. And then this is the regular DXY. If anything, this is a little bit less bullish than the other ones, but the dollar is not dying. It's actually breaking out. So this is going to cause stress in the market, the global economy. And we have one here. Let me get this. I'm going to get this tweet and bring it up. Stand by. I should be playing music in the background. Okay, share this tab. This is from Ash Crypto Real. And you've probably seen this all over the place. This is the repo, overnight repo. So it's kind of like the overnight window at the Federal Reserve. And you can bring your collateral in here and they can give you dollars. So when you hear repo, that in finance, that means you bring dollars or you bring collateral, which is U.S. Treasuries, and they'll give you dollars for your overnight financing needs. There's also reverse repo when you bring dollars and they give you collateral. They give you Treasuries back. And one of the things that was going on in the last 4 or 5 years since well, let's see, when did it start? Did it start with Signature and Silicon Valley banks? That regional bank issue that we had, I think that was in 2023, March of 2023. They started a reverse repo facility at the Federal Reserve. So people were bringing in their cash and they were getting collateral. They were getting treasuries because they needed that to reliquify the financial system. So the way the financial system works is it's a bunch of these interconnected banks, and the way money flows is you need to have collateral going one way and cash or dollars going the other way. The way I like to talk about liquidity is what's the viscosity in the banking system. Is, as viscosity goes up, that means it actually gets slower. So molasses is highly viscous liquid. Water is very low viscosity. So if they're very high viscosity, it means money's having trouble moving through the financial system. Okay. And usually that is because there is impaired collateral out there. So cash is king, cash is, pristine, and it can move freely. But the other side of the trade is collateral, right? And so the collateral, when the collateral gets impaired and I don't trust this collateral, then the viscosity goes up and the liquidity goes down in the banking system. So if you put more collateral out there, more treasury bills that are pristine collateral, they're the best other than cash, then you can liquefy the system, or you can push that viscosity down. So that is reverse repo, and that's what they were doing for a couple years. That has now since drained, and this is the repo from the Federal Reserve. So they're bringing collateral and they're getting cash. So there's a dollar shortage going on, and this is exactly what we would expect to see the dollar breaking out over 100 when we're having this dollar shortage being represented in the Fed's repo. So it all connects, it all matches. It's exactly what we would expect. This is not like the system is crashing or it's going away imminently, or this is just a measure of stress. And one of the things that I point out in my analysis is that the Fed follows the market. Okay, so when this is happening, stress is just appearing. It's not the result of some, benevolent central planners out there. These stresses just appear in the marketplace. There is a rhyme and reason, because we're over indebted, and eventually the overriding pressure is towards deflation. The overriding pressure is towards default. We are way over indebted as a global economy, as a domestic economy, as governments, way over indebted. And so that obviously means the overriding pressure is towards default, which is a deflationary event, a hyper deflationary event, because all money is credit, all money is debt. Like I said, dollars are printed in the process of making a loan. They are the debt itself. And if debt is defaulted on and goes away, dollars disappear. So, and liquidity dries up, viscosity goes higher, money stops moving. This is a deflationary pressure. That's the overriding deflationary pressure. And you can push it off for a time. You can change your rules. That's what the Federal Reserve likes to do. Change the rules, create a new facility, try to keep things moving, keep things liquefied, keep the resistance in the system to a minimum, and you can have a decent recovery, a decent reflation. But eventually that overriding pressure is to the downside. It is towards deflation and shortages. Even if you double the amount of government debt, it's because it's built into the system. It's like adding more debt to get out of a debt problem. It just doesn't work. The overriding pressure is still towards deflation. And that's what we're seeing here in the repo chart. We're seeing a resurgence of deflationary pressure right here. This is dollar shortage. And we see it in the DXY that we just looked at. Dollar going higher, repo exploding, dollar shortage. That's what we're seeing. But this was another good chart. Let's see. I had one of the replies here. If I can find it. Here it is. From Victor Techmingler. And here he says, banks liquidity drying up. I would say viscosity is going up, not necessarily liquidity drying up. They don't have enough cash to lend each other for one day. Fed repo all in. Also look SOFR and reverse repo spread attached. Almost COVID crash level. So this is the spread between SOFR and reverse repo. Back here is COVID. Rush towards cash. And we're seeing that here as well. So this is a significant pressure. We are seeing something. And if you guys follow me, one thing, I do cover the Federal Reserve press conferences. We go live on my Telegram channel. You can find that in my bio. Let me bring this back up. But a couple meetings ago, I said, hey, they're going to be forced to do an emergency cut. I just got this feeling watching the press conference, listening to him talk about the slides, the SEP, the Summary of Economic Projections, listen to him answering questions from the audience. And I was like, it just struck me, this feeling of they are not ready. They're going to be forced to cut an emergency cut. That did not happen. But I think this is the stuff I was feeling here. This explosion in repo. There's something out there that is starting to build. This deflationary pressure is starting to take over. Now, it's very interesting as well. The timing, this was at the end of October, about a month late, because end of Q3 is my big seasonal choke point. Of course, that does spill into October. There have been major crashes in October and September, and this is the end of October, so the end of that kind of third quarter window, and that's when we saw this deflationary pressure be resurgent. So not exactly end of Q3, but very close. Now, by this last meeting that they had last week, I was much more calm. I thought that Powell was doing fine. They made it to the next meeting and they cut another 25 basis points. They made it that now they're kind of, it looks like the market is going to let them a soft landing. But a few days later, this repo starts raising its ugly head. DXY is breaking out. It looks like they might have to do another emergency cut before December. I don't know. We're going into this time of year when things should be good. We should be able to coast to the end of the year. Economically, financially, that's just the way that the calendar works. We usually can coast in November and December to the end of the year. And then in Q1, stresses usually start building back up. And by the end of Q1, we have another choke point. So maybe they'll be able to tamp this down, and make it go back to normal. I mean, we did go from, looked like about 50 billion overnight 2 nights ago to only 7.75 billion, or no, mortgage-backed securities. So this is over 20 billion. So from 50 down to 20 billion last night. So it looks like there is some relief here going on. And if they can tamp this down, coast out to the end of the year, that's what I'm really looking for. Getting over this hurdle is going to be bullish for everybody. Bullish for everything macro, at least domestically here for the United States. We'll see. It would be bullish for emerging markets and for foreign markets as well, because the dollar should, if they can get over this hump, the dollar will not, crush people as quickly and as badly. So if we see the dollar continuing to tick higher and we see this repo continuing to be used night after night, that's really bad for the international markets more than the domestic U.S. markets. And also some of these, you start bringing in like geopolitics here. Access to swap lines and things can be a geopolitical weapon. If the U.S. doesn't get their way in some sort of negotiation and the target country wants to access swap lines because they're crashing, their economy is crashing, their banking system is crashing, the United States could, I don't know what the exact legality here, but the Fed and the Treasury could probably block swap lines to those countries as a geopolitical weapon. So that's something to be watching out for as well. But overall, that's where I think we are for the dollar. Now, going back to the charts, let's take a look at some other markets. Gold, as we wrap up here. Gold down, we'll go down to the daily. So at this top, I was watching this. I want to say I called the top here, but I think everybody was calling top, and I was saying, oh my gosh, this is so overheated. I remember looking at the monthly chart. Let's go to that. Bring up the RSI. I was looking at the monthly RSI, and I'm like, this could go on for another month, but we are getting very close in time to the top. Where the top is, could this spike to 5,000? Yeah, I said it could. But we are close in time to a top. And it happened to be very close in time to a top. And we sold off, or gold sold off. Kind of got supported on this first line. I said, this is the first line of support. Held it up for a few days, then crashed below, went back up and tested that support, and that turned into resistance. This is classic TA. I mean, nothing really to this here. Not special. It's just exactly it. People find TA hard to deal with because it's like, it's almost like a, not self-fulfilling prophecy, but it's like magic, right? Well, yeah, it's because it's human behavior. It is Schelling points. That's what I like to talk about. So if you guys know things about focal points and Schelling points, I think that's a lot of technical analysis. These are points that, absent communication, it's natural that you pick it. So for example, if I'm in a classroom and I'm a professor and I have a slide up on the screen and there are 4 squares, 3 green, 1 red, and I pick 2 people out of the class, they cannot talk to each other. They cannot look at each other. They have to write their choice down on a paper. And I say, if you 2 pick the same square, I'll give you each $20. What are they going to do? They're both going to pick the red square, not the 3 green squares, the red square, because there's something different, because there's something that is focusing your attention on that square. And this is highly, highly accurate. It's part of game theory as well. But the focal points on the chart, support, resistance, moving averages, those type of things are extremely powerful focal points on the chart, and they attract bids and asks. They attract orders. So when this is coming up, like if I missed selling, missed selling, I'm going to place a sell back here. And then when the price recovers and touches that, it triggers market sells that missed the breakdown. And then it continues to go back down. Okay, so it's focal points, it's understanding orders, all of that. The next big support, this is a major focal point. And so I don't know if it can resist coming down here. I think it's going to act like a magnet. So let's put this magnet in here. Do we have a magnet? Where is my magnet? I can't even search, can I? Yeah, I can't search for a magnet. But this is a magnet line, focal point, major focal point. You can see it goes all the way back here. Nearly perfect with all these tops. Gap in the chart. That means the market moved after hours and it opened up higher. Usually these gaps get filled because they are focal points as well. But you can see there's a few little lines of maybe support you could find in here. But I don't think they're going to be as much of a focal point as this first one. First one from the top coming down, that's the first line of defense. So these ones aren't going to be as strong, and this is going to be a magnet. And man, is the market going to be on fire when gold crashes down to 3,500 from almost 4,400 down to 3,500. Massive, massive move. But that's what you have to do. That's what happens with markets when you have this kind of blow off top. Everyone's saying the dollar is causing this. Dollar weakness. The government killed the dollar. The Fed killed the dollar. But what are we seeing on DXY? Nothing of the sort. Breaking out back over 100, back over this long-term support, turn resistance, breaking it again. People just don't understand the way the dollar works and the way the banking system works. Even like very popular analysts out there. It was fairly simple to call that the dollar will strengthen. It's fairly simple to call that gold was overextended. if you're not wedded to your certain ideology that the dollar is dead, the dollar is evil, US government is bad, if you're not wedded to that and you want the truth, these type of things jump out at you. So that's gold. I do expect it to come down here. I don't know how fast it gets here, but it will get here almost. I am fairly highly certain, because it is just such a focal point with this gap, with these multiple highs. Will that be eventual support? At least temporarily, yes. It could go even lower though. But it almost certainly, I mean, I'm about 90% sure that this is going to happen. Maybe by the end of the year, maybe in 2026, Bitcoin will have its run up after this now, after gold, to catch up, and we'll see where that takes us. All right, let's look at some other markets. This is the 10-year Treasury. We're just having fun on a stream here. I don't know how many views I'll get, but hey, just having fun with macro. Like and follow. First month of this account got up over 100 followers, trying to hit another 100 every month. Hopefully 1,000, get to a point where we can get 1,000 a month, but make sure you follow this account. We will be doing these lives regularly. Also the Substack at roguemacro.substack.com. You can follow my writings there. Support me financially. All right. So this is the 10-year. This is the federal funds range, policy range. In its stair steps, you can see they just cut another 25 basis points, between 3.75 and 4% now on their policy. So if we take this off, well, let me talk about this. So you can see with these cuts, okay, when the Fed started cutting again in September, and the 10-year was rising, there were so many calls out there on X from these financial gurus. Oh my gosh, the 10-year is going higher after the Fed rate cut. The 10-year, the market is rejecting the Federal Reserve. This is going to break out and we're going to go higher. There's going to be, I didn't necessarily see this, but the idea is that there's going to be uncontrolled higher interest rates because demand for US government debt is going to drop. Because the dollar is so terrible, the US government is so terrible, everybody hates us, blah, 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 blah. But no, this is very simple. Okay, very, very simple. Rate cuts, are they supposed to be bullish? Or are they supposed to be stimulus? Or are they supposed to be restrictive? Accommodative or restrictive? They're supposed to be accommodative. They're supposed to be that kind of stimulus, help the economy out, easing. What will happen to the economy then? Well, the economy should do better. If the economy was in a certain condition under this rate, if you lower that, the economy should be doing better. That's the idea. That's the concept. I'm not saying I agree with that, but I'm saying that is the concept, right? And so what does the market do? Well, if the market prices in a little bit more future growth, perhaps even inflation expectations, but future growth expectations. And what does the 10-year represent? It represents future growth and inflation expectations. So as the Fed cuts, the market temporarily prices in more growth and inflation. All right. But then reality sets in. Oh no, nothing was fixed. The pressure is still deflationary, right? Like we talked about earlier. So then the rates start falling. The rates start falling again. And you can see that this kind of zone of uncertainty is higher than this zone of uncertainty, not by much. So that it's not really bad deflation pressures, at least that the market is pricing in right now. We'll see how this repo gets priced in over the next week or so. But then they cut again. All right. And what happened? The market is giving the Fed, giving the economy the benefit of the doubt that they will be able to cause growth, that this will be positive for growth. This rate cut will be a good thing, but that's going to wear off very quickly, and we'll see the 10-year continue to head down. That's what this arrow is here. So very simple if you know how to treat the market. All right, the deflationary pressure is the overriding pressure. Let's look at oil. Let's see if I have any comments from Telegram. Don't know what that means, bro. Let me see. All right. Let me see if I can see any comments below this stream. I'm not in a rush. Don't have anybody to please here. Let's see. No comments below. That's all right. That's all right. We're getting going here. Okay, so oil. Let's take this off. We've talked about this a lot. Let's go to the weekly just to see. And generally, price is very, very weak. A lot of people back here were calling for $200 a barrel. I'm saying, no, this is overheated. The market cannot support this. The market cannot support higher prices. So the cure for high prices is high prices, right? It squeezes the economy, makes people tighten their belt, demand falls, marginal demand falls, and price falls. So the cure for high prices is higher prices. Well, that's what happened back here in 2022 with the invasion of Ukraine by Russia. Lots of people talking about $200 a barrel, $300 a barrel. I just saw another one talking very recently about $300 a barrel, and I pushed back on X, and then he's like, don't you know who I am? I mean, obviously I'm a small account, but I'm not an idiot. I've been here a long time. I've made these calls. He's like, I was the only one calling for price declines back in 2022. Okay, well, I was also publicly. And so you're not the only one, bro. I even called this behavior, this oscillating up and down behavior to an eventual breakdown. And that's exactly what we saw. But he's like, I'm the only one to call. I'm calling for cheaper oil and then more expensive oil up to $300 a barrel. All right, bro. See, the thing is that markets cannot support that kind of price. So, yeah, we might see something back at 100 or 120 maybe in the far, far future. But that won't last long because the market simply can't support it. Also, we have a demographic problem where something like Japan is losing 1 million people a year. And I just saw this. Let me bring this up. So this is something I saw last week. I have written a post about oil consumption in Japan. And it was kind of back of the napkin math saying, oh, what's going to happen with this demographic decline? They're losing 1 million people a year, right? And I said, well, the demand for oil is going to probably drop by 1% a year. And what does that do to the global demand for oil? The marginal demand is going to be shrinking. But we don't only see demographic decline in Japan. We see demographic decline hardcore in South Korea. Slightly smaller economy, slightly smaller population, but it is marginal. Then we have China, much bigger population, much bigger collapse. Like right now, China is at 1 million, just like Japan, losing 1 million people a year. Pretty soon, they're probably going to be at 10 million. If you go 5-10 years in the future, they'll be at the 10 million person mark, where their population is shrinking by 10 million a year. Now, that's a major marginal demand for oil collapse. But then we can go over to Europe, the European population. I think it's flat now, but it's just rolling over into declines. with maybe this year, within the next couple years. There's going to be population declines in Europe. So the marginal demand for oil is going to go down. At the same time as we have the inability to service higher prices. So the end result of this is gently falling prices of oil for a very long period of time. So let's look at some of these charts here from John Kemp. This is the resident population. See, it peaked in 2010, 128. And we are right in between here, about 122 or so. But let's look at the demand for oil. Let's make sure that's the right peak year. Hold on a second. Median age. Okay, this is population. Prime age population. Okay, this is an important chart too, but we're not going to get into that. So this has a peak around 2010. So now let's go to oil consumption. Oil consumption. It's on the decline. This makes sense that it's not a peak at the exact same time, because what happens before the peak population? An aging population. So if we go back here, and median age, you can see it's from 36 in, well, let's say go from 2020, it was, sorry, from 2000, it was 40. In 2010, it was 44. All right, now if we go down back to this, 2000, it was 40. 2010, it was 44. So the average age got older. That's why we saw this decline. Because what happens? Older people don't consume as much. They're not as vigorous economically. That prime age group is 25 to 45, or maybe 25 to 55. That's the prime age group. And if your average population is getting older, that means the average consumer is consuming less because they're getting older. So that makes sense that why this oil consumption started dropping off as this, before they hit peak population in 2010, it already started dropping off because of the aging of the population. But you can see here that the peak was 1995 at 270. This must be a million tons. I don't know how many barrels that is, but 1995 here at 270, and it's down all the way to 150 as of 2023. So what is that? About a third? It's already lost a third of their oil consumption, and they're going to continue down. This is not going to stop. The demand from Japan, from China, from South Korea, from Germany, from France, from Italy. Well, maybe not France. They're much more stable population. Spain. To a lesser degree, the U.S. The U.S. will slow down, but we still are going to be growing for a couple more years because we're about 20 years behind these other countries. But marginal demand is going to continue to fall. All right, let's go back to oil. So in that respect, weak marginal demand is the future. We have this double bottom. I don't think that will, well, that might hold, but we'll see. We'll see which line breaks first, whether it's this line or whether it's this support. We will see. Yes, there will be some demand destruction and some hard times for producers if we drop down to 50, but I still think we hit 50 before we hit 90. And I've been making that call for a long time, probably a year now. I've been saying we're going to hit 50 before 90. All right, so that's oil. How about S&P 500? Let's go to the daily first. And market is open, so let's take a look. Opened with a big gap down, but it is positive on the day, so we'll see where this ends up. There is this gap right here. So this gap might touch that and go up, but we are right near all-time highs, and I don't see anything stopping this train for the stock market unless this dollar shortage gets intense over the next week or so. I don't think that's necessarily going to happen. We're probably going to see some comments by the Federal Reserve. We're going to see some comments by Bessent. They're going to try to talk the market off of the edge, talk the liquidity back into the banking system. But if that does continue, we could see a sell-off. But right now, this doesn't look like a top, but I will, of course, keep you updated there. All right, guys. So check out roguemacro.substack.com for all of my other content. And thanks for joining. Make sure you like and follow this account, Rogue Macro. See you on the next one. Bye.